Here's something that sounds completely wrong the first time you hear it. Buying stocks when the market is at its most expensive, historically, has actually outperformed waiting for a cheaper price. Yeah, let that sink in for a second. Because if you're like most people, every instinct in your body is telling you that's backwards. Welcome to Mavic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. I'm just here to walk you through the data and let you draw your own conclusions. Today we're tackling one of the most persistent myths in investing, the idea that buying at an all-time high is basically financial suicide, and that the smart move is always to wait for a dip. We're going to break down why that instinct exists, what actually happens when you test it against real historical data, and what that means for how you should be thinking about your own money right now. So, let's start with the problem. If you've ever had cash sitting in your account, ready to invest, you've probably felt this exact hesitation. The market's at an all-time high right now. Doesn't that mean it's about to crash? Shouldn't I just wait for a pullback and buy in cheaper? It's a completely reasonable thought. It feels smart. It feels disciplined even. Nobody wants to be the person who buys right before a crash. That fear sticks with you. Loss aversion is powerful, and the idea of watching your investment drop the week after you bought it feels almost humiliating, even though logically it shouldn't matter that much in the long run. But here's the thing. An all-time high isn't actually a warning sign. It's just a number the market has never reached before. That's it. Markets spend a huge amount of their history sitting at or near all-time highs, simply because healthy markets trend upward over time. So if you refuse to buy whenever the market is at a new high, you're essentially refusing to buy during a huge chunk of market history, including periods that turned out to be great times to invest. So why does this happen? Why do our brains treat all-time high as a red flag? Think about it like this. Imagine you're at a farmer's market, and you've been eyeing a particular stall selling apples. Every week you check the price, and every week it's gone up a little. This week, the apples are more expensive than they've ever been. Your gut says, wait, that's too expensive. I'll come back when it drops. But what if the apples never drop back down? What if next month they're even more expensive, and the month after that, more still? At some point, waiting for a price you remember from 3 months ago isn't a strategy. It's just delaying a decision based on nostalgia, not on whether the apples are actually worth buying today. That's essentially what happens with stocks. The price today reflects everything the market currently knows: company earnings, economic conditions, expectations for the future. An all-time high simply means the market currently believes things are going reasonably well. It's not automatically a signal that a crash is coming. Now, let's actually look at the data, because this isn't just a theory. It's been tested. Researchers looked at what happens if you invest specifically on days when the market hits a new all-time high, compared to investing on any random day. Studies from firms like Hartford Funds and analysis referencing decades of S&P 500 performance have found something consistently surprising. Investing at all-time highs performed about as well, and in many time horizons, even slightly better, than investing on an average random day. Over 1 year, 3 year, and 5 year periods following an all-time high, the market was still up the vast majority of the time. Why? Because all-time highs tend to cluster. Once the market breaks a record, it often keeps setting new ones for a while, because a strong economy that produces one high tends to keep producing more of them. Waiting for a big dip means you might be waiting for a moment that simply doesn't come, sometimes for years, while the market continues climbing without you. Let's make this concrete with a scenario so it's easier to picture. Meet Wendy and Bridget. Wendy is cautious. She's got $10,000 ready to invest, but the market just hit an all-time high, so she decides to wait. She tells herself she'll invest as soon as there's a meaningful pullback, say, a 10% dip. She checks the market every week, waiting for her moment. Bridget, on the other hand, just invests her $10,000 right away at the all-time high and doesn't touch it. Here's what tends to happen in scenarios like this, based on how markets have historically behaved. The dip Wendy is waiting for doesn't show up for a long time. Sometimes 18 months, sometimes longer. Meanwhile, the market keeps climbing another 8, 10, 15% higher. By the time a real dip finally happens, it often only brings prices back down to somewhere near where they were when Wendy started waiting, not actually below it. Bridget, who just invested and stayed in, ends up ahead because she captured all that growth in between, while Wendy captured essentially nothing, and in some cases ends up paying more for a discount than Bridget paid at the expensive price. This isn't true in every single scenario. There absolutely are moments where waiting would have paid off, especially right before a major crash. But that's exactly the catch. Nobody can reliably predict when those moments are. Bridget's strategy doesn't require predicting anything. Wendy's strategy requires being right about market timing, which even professional fund managers struggle to do consistently. So what's the real takeaway from all of this? It's not about timing the market. It's about time in the market. The value of staying invested consistently tends to outweigh the value of trying to catch the perfect entry point, because the cost of waiting and missing out on growth usually outweighs the benefit of occasionally buying a bit cheaper. Now, I want to be honest with you here, because I don't want to oversell this. This doesn't mean all-time highs are magic, or that prices never crash after one. They absolutely do sometimes. Markets are not automatically due for a correction just because they've been going up, but they're also not immune to one just because they hit a record. This isn't a black and white decision. If you have a very short time horizon, say you need this money in the next year or two, the calculation is different, and taking on that risk deserves more caution. This strategy works best for people investing with a long time horizon, using diversified funds rather than betting everything on a single stock. It's also worth saying, this doesn't mean you should dump your entire life savings into the market in one shot, regardless of your personal financial situation. What the data supports is this. Don't let the fact that the market is at an all-time high stop you from investing consistently, especially if you're using something like dollar cost averaging, where you're investing a fixed amount regularly regardless of the price. Here's a helpful way to think about it. Investing isn't like buying apples at a market, where the goal is to grab the cheapest price on a single day. It's more like planting a tree. It doesn't really matter what day you plant it. What matters is that you plant it and then give it years to grow. A tree planted today at a high price of soil conditions will still be enormous in 20 years. A tree you never plant because you're waiting for perfect conditions never grows at all. So if you've been sitting on cash, hesitant to invest because the market feels too high right now, here's the honest, data-backed takeaway. Waiting for a dip that may never come, or may not even undo the highs you're worried about, has historically cost people more than it saved them. Consistency beats perfection. The all-time high you're worried about today will very likely look cheap 5 or 10 years from now, the same way today's prices look expensive compared to 5 years ago, but cheap compared to 5 years from now. As always, this isn't a one-size-fits-all rule, and your own situation, your timeline, your risk tolerance, your financial goals matters more than any general trend. Always do your own research or talk to a financial advisor before making big decisions with your money. If you found this helpful, I'd really appreciate it if you liked and subscribed. It genuinely helps this channel grow. I'll leave another video here that you'll probably enjoy just as much, where we break down dollar cost averaging versus buying the dip in even more detail. Thanks for watching, and I'll see you very soon. Bye.